Ladies and gentlemen and work experience students, here is a quiz from last time. So see if you can answer these in your notes. I know it's kind of rough to start off with a little quiz, but let's see what you remember from last week. Answer these questions. Answer those questions. If you don't know any of those, it's pretty important. So ask next time you see me. All right, part 3, diversify. All right, write this down. Don't keep all your eggs in one what? What is the answer there? And what does that mean for investing? What does that mean for investing? What do you think? Answer those questions. Okay, so principle 4 of investing is spread your risk around, which is also known as diversify. So basically, if you look at this, the general trend towards market, so stock prices typically over time go up, up, up. But there's those little, they'll go up, 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 and then they'll dip, and then they'll go up, up. So overall, they go up, but sometimes they go down too. And sometimes companies just do poorly. You might buy stock in a company that just does terrible and fails totally, right? For the most part, stocks are going to do well. Sometimes they don't. Sometimes they totally fail. So basically, the idea is, so you invest in multiple different things, right? So if you invest in Walmart, right, and Walmart's doing bad, well, if you're investing in Apple, at that same time, Apple might be doing well, right? So spread your risk around to multiple companies, and that it balances out your possible losses. All right. So write this down in your notes. Diversify. If you have your money in a wide variety of investments, it will be safer. Okay. Some stocks do well when the economy is bad. Like, for example, when the economy is bad, companies like Walmart and Amazon typically do okay because people are still buying groceries. People are still buying stuff. A company like Apple or GM might do poorly because, okay, the economy is terrible. It's like, well, I may not buy that new iPhone. I may not buy that new car. So real estate is kind of doing its own thing. So like when the regular economy is bad, sometimes real estate's doing really well, right? So right now the economy is not doing great, but the prices for the rents are way up and the prices for houses are way up. So sometimes real estate is kind of on its own little wave that's not totally related exactly to what the rest of the economy is doing. All right, so I want you to think about this. How can you diversify your portfolio? So if I'm asking you to buy stocks, you're pretty limited on cash, right? Let's say you're going to buy $100 worth of stocks, and Apple Computer costs $400 per share. Like, how can you diversify? How can you buy a bunch of different companies? Okay, so answer those questions. All right. So type of stock investment. All right. So the rate of return is how much money you make each year from your investments, right? So if you invested $100 and you made $10, that would be 10%. Risk equals the possibility that you will lose some or all of your money. So if you're investing in stocks or bonds or real estate, you could lose all your money. And then liquidity is how fast you can get the cash. So for example, if you put money in the bank, the next day you want the money out of the bank, you can get that money out of the bank. So it's very liquid. On the other hand, if you buy a house and the next day you want to sell the house, you can't get that money. So I heard this once that, hey, if you want to sell a house fast, what that means is you're going to lose money. You're going to have to sell it cheap, right? So you can sell a house quick, but you're going to have to sell it for a low price. All right. Individual. Okay. So you can buy individual stock shares. So you can buy one share of a company. So it might be expensive. You have to do all the research yourself and make sure that it's a good company. You're not diversifying, so you're putting all your money into one stock, and so you're not diversifying, so you're not spreading the risk around. So that makes it more risky unless you buy a bunch of stocks. So like if you're going to choose individual stocks, you should probably buy at least 25 different companies to spread that risk around. And you may find it fun, or you may not find it fun. So if you enjoy like doing that, that might be a good idea for you, right? But you're going to have to figure out how to diversify that. So if you're going to buy your own individual stocks, you're going to have to figure out how to spread that around like 25 or more stocks. So if you buy one stock in one company, the risk can be high or low, depending on how the company does, but you have a chance of good returns. The risk is very high. And then the liquidity is medium to low because you have all your money in one stock. If that stock is down today and you need that money today, well, you either can't get the money because like I'm not willing to sell the stock when the price is low, or you'll have to wait it out. Okay, another thing you can do now. Here is a good option. It's called a mutual fund. A mutual fund pulls money from many investors and invest in a variety of securities. So the return is good, the risk is medium, so your risk goes down, and the liquidity is a little bit is medium. So still you still have that issue of if the prices go down and I need the money right now, you're going to just have to take the loss. So it spreads the money to a lot of securities, so it's safer and it's managed. So you have smart people buying and selling for you. So here's what it looks like. So a bunch of different people. So instead of one person buying one stock, you have all kinds of people, hundreds and hundreds of people putting millions and billions into an investment firm. So they give it to a company and they buy and sell stocks for you. So they think, oh, this stock looks good, so we're going to buy it and put it in this mutual fund. Oh, that company's not doing very well. We're going to sell it. Okay, so stocks, bonds, and so they take all these people's money and they invest it in stock, bonds, and securities. So it's you put a little bit of money in, a bunch of other people put a little bit of money in, and then they buy billions of dollars worth of companies, and it's managed for you, right? So by doing this, you're spreading your money around into a bunch of different companies, and so it really lowers your risk. Okay, because not all those companies, stocks and bonds and all that stuff are going to go down. Okay, so this is a good way to invest in the stock market and and diversify, right? So buying individual stocks has its merit, but this is a good way to diversify mutual funds. All right, another way is ETF, exchange traded fund. Okay, you can take a look at this, but basically it's really similar in that a bunch of investors decide, hey, I want to buy that ETF, right? So it's one stock that holds a bunch of other stocks, so tons of companies involved in it. And so this one is there's not management fees. So when you buy a mutual fund, part of your money goes to paying for these people to manage it, right? So they take a little cut. When you do a ETF, there's not a whole lot of management. They basically just said, hey, you invest in this, you're gonna put your money in stocks 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, right? So it's not going to change all that much. You're not going to pay a lot of management fees. So this is probably the best option for you guys right now because nice way to diversify, nice way to get your feet wet investing in the stock market, and you're not paying a bunch of fees. So and these, by the way, you'll see a lot of these on the brokerage accounts that you can get right now. Another great option, which is this is probably what I recommend the most, is you can buy an ETF fund that's an index fund. Okay, so basically the same kind of thing is lots of people put their money in to a stock, right? And it can be so. Let's say you did an index fund that was the S&P 500. Well, they invest in those 500 companies, right? So your $5 gets split to these 500 different companies, and so pretty good diversification. And the reason I like this one for you guys is that when you read the news or listen to the news on the radio, they're always going to tell you how the S&P 500, the Dow Jones is doing, the Nasdaq. So you can always kind of hear how things are going. Okay, so the idea is an easy way to diversify is you buy an ETF or you buy a index fund or you buy a mutual fund, and it automatically puts your money in a wide variety of investments. It's going to be safer. So when some stocks do okay, that's in part of that fund. Others will do well. Okay, and then real estate's a whole other thing. That's a pretty good idea. Okay, so the next part is choosing stocks. Um, so whenever you buy a stock, the idea is get a company that's a good company that's going to be solid, right, and hold on to it for 5 or more years, right? Because as we looked at those numbers, right, if you buy it here and things get bad, well, if you wait long enough, things are pretty, for the most part, going to go well if it's a good company. Okay. Um, so the investors that do the best are the ones that buy a diversified collection of stocks. They have money in a bunch of different companies and hold them through good times and bad. So buy a stock as long as it's still a good company. Hold on to it for five years before you sell. Okay. All right. So we want you to actually buy stuff. So here's my money plan. Look this over. This is what I would like for you to do. And so as part of that, um, do this. All right, put this in there. Okay, so a ticker. So let's take a look at this. So if we did a ticker here, so if we did like, what's a ticker? So if we say, what is Apple ticker? So this is how you would look up is AAPL. So if you want to find out how Apple's doing, you're going to look up AAPL. That's how it's bought and sold. So right now, this is how Apple's doing. It's doing well. Let's look at how it's doing Max. Oh my goodness! So if you had bought an Apple way back when they first started, you would have made a lot of money. Okay, so anyway, so a ticker symbol is how you know. So like whenever you see AAPL, you know that, oh, that's Apple computers, Apple phones, and so on and so forth. So that ticker is a symbol that they go up. So look up one company that you're interested in and see how they're doing today. So there's different strategies for buying stocks. So strategy one is buy what you know. So buy a stock in a company that you like. Like, hey, I think Under Armour is a good company. I like their products. So you know a little bit about them and do some research. Just see how they're like. Okay, they have good products. Do they have good management? Are they actually doing well right now as far as their stock prices? So do a little research after picking a company that you like their product or service. Strategy two is follow advice. So you can go to like a website that gives advice. You could go to YouTube and search for like, hey, give me some stock picks, and just listen and see like if you like what's being told to you there, and go with that route. And then strategy three is just choose a blue chip stock. So a blue chip stock is a large cap stock, which means it's a company that's worth a lot of money. And so a blue chip stock company is a company that's done well over time. They've like pretty much always done pretty good. And so if you get a blue chip stock, the chances are they're gonna keep doing well. Okay, so these are companies like Apple and Google and IBM and Ford and companies like that. Another strategy is choose an index fund. So invest in the Dow Jones, the S&P 500, or the Nasdaq, or there's other ones too. But these are typically overall these funds usually do pretty well over time. So that would be a good way to do it too. And strategy five is just find an ETF fund. So let's say that I think that electric cars are going to do well in the future and batteries, right? So you can find a fund that's focused on solar power, battery powered cars, things like that. You could find a fund that, let's say you think that, oh, I think the economy in China is going to do well in the future. So you could invest in upcoming companies in China. So there's all kinds of different ETFs you could invest in. So to kind of have an idea of an area that you're interested in, and you could choose an ETF in those. Okay. Here's my investment strategy for you. So start early, invest regularly, buy and hold on to stock for at least 5 years, diversify over time. So if you buy one stock now, buy stock in a different company next time, right? And so spread it out. Keep things simple, right? You don't have to have a really complicated strategy to win. Just buy good companies, buy a bunch of different good companies, and keep investing over time. Invest in things you understand after doing some research. So make sure you know what you're investing in. Take advantage of changes. So for example, right now the economy's bad, so it's a good time to invest in just about anything. Use advisors that you understand that have the heart of a teacher, not the heart of a salesman. Okay, so what I want you guys to do is do this worksheet, and I want you to pick one strategy. You're not going to pick two strategies. You're not going to pick all the strategies. You're just going to pick one, and pick a stock or a fund, and either just pick it and track it over the next few weeks, or actually go to your brokerage account and do what it says. Okay, so strategy one is the one we already went over. Buy what you know after some research. Strategy two is follow advice. Just get some advice from online and just go with it, because you're just learning and there's not a whole lot at stake right now. You're just going to invest a little bit. Choose strategy three, choose a blue chip stock after some research. So just pick a big successful company and just make sure that they're still making good choices. Strategy four, choose an index fund. And strategy five, choose an ETF fund. Okay, so I want you guys to pick one of those and then answer those questions, and that's going to be your homework for the week. All right, thanks, guys.